Warren Buffett, the legendary Oracle of Omaha, hasn't merely achieved investment success. He has revolutionized the financial world over 6 remarkable decades. His investment vehicle, Berkshire Hathaway, hasn't just performed well, it has crushed the market with a staggering 20.1% average annual return since 1965, more than doubling the S&P 500's performance. These extraordinary results don't spring from mysterious formulas, exclusive insider information, or risky speculation. No. Buffett relies on timeless, crystal-clear principles accessible to anyone brave enough to swim against the current. With watchmaker precision, he follows the value investing philosophy instilled by his mentor, Benjamin Graham. Like a hunter on the prowl, he tracks down companies possessing crucial qualities: unshakable financial health with minimal debt, powerful cash flows, and rich profit margins, an insurmountable economic moat that drives competitors to despair, a management team of exceptional integrity and brilliance, a business model of compelling clarity, and a valuation that practically begs for investment, with the price-to-earnings ratio, PE, as his compass. With the sharp eye of an eagle, Buffett identifies companies whose market price falls far below their true intrinsic value and strikes when others hesitate. Buffett's investment philosophy crystallizes in a single powerful sentence: "Our favorite holding period is forever." This radical long-term perspective places him in dramatic contrast to the frenzied Wall Street, where stocks change hands faster than playing cards in a casino. The average holding period today is under 6 months. The iron patience with which Buffett nurtures his investments isn't just a success factor, it's his secret superpower. Like a wise gardener, he has cultivated Coca-Cola since 1988, watching it grow into a $25 billion giant. He's held American Express since 1964, an investment that has exploded by 1600. These success stories underscore his mantra: time is the friend of the wonderful company, the enemy of the mediocre. The recent chess moves of this investment genius reveal his razor-sharp market assessment. Berkshire Hathaway's cash reserves reached a dizzying all-time high of $334.2 billion by the end of 2024, a war chest nearly equal to the entire market capitalization of the company. This monumental liquidity reserve sends an unmistakable signal to the financial world. Buffett senses danger and is preparing for the coming storm. Like an experienced sailor before a tempest, he reefs his sails and waits for the perfect moment to strike. His famous credo echoes through the trading floors: "Be fearful when others are greedy, and greedy when others are fearful." With this mountain of cash, Buffett fires a warning flare into the sky. The market is overheated, and wise investors should be on the lookout to pounce when others panic. A particularly bold move in Buffett's strategy is his targeted expansion into Japan, a maneuver that surprised many. With surgical precision, Berkshire Hathaway has invested $23.5 billion in 5 Japanese trading giants. These companies, Itochu with its expertise in textiles and machinery, Marubeni with its energy empire, the industrial titan Mitsubishi, the raw materials colossus Mitsui, and the metal processor Sumitomo, shine with spectacularly low PE ratios between 5 and 8 and entice with attractive dividends of 3 to 4%. These valuations are so appealing that compared to Western companies, they appear like hidden diamonds. This strategic thrust demonstrates Buffett's deep trust in infrastructure and regulated earnings, a brilliant maneuver in times of looming inflation. Despite his extreme caution, Buffett strikes where others see only risks. He has increased his stake in Occidental Petroleum to over $283 billion, a sum nearly equal to his entire company's market capitalization. This massive commitment resounds like a thunderclap in the financial world. He finds few attractive stocks and is preparing for a market collapse where he will strike like a predator. A central building block in Buffett's success formula is his almost obsessive focus on return on invested capital, ROIC. This metric measures how magically effective a company transforms its capital into growth. The crown jewels in Berkshire Hathaway's portfolio typically achieve a ROIC exceeding 15%, far above usual capital costs. This explains his passion for Apple with its phenomenal ROIC of over 30%, and his aversion to capital-intensive industries with meager returns. For Buffett, stock buybacks are only appealing when executed at bargain prices. Anything else he considers wasteful. Perhaps the most powerful tool in Buffett's arsenal is the Multiplier Principle, a strategy that ignites multiple growth engines simultaneously. With the instinct of an apex predator, he hunts down companies that can combine organic growth, exploding profit margins through scale effects, strategic share repurchases, and brilliant acquisitions. Apple perfectly embodies this principle. It grows organically, maximizes its margins, aggressively buys back its own shares, and expands its ecosystem through tactical acquisitions. A quadruple growth turbocharger. For investors seeking to replicate Buffett's recipe for success, the key may lie in a concentrated portfolio of 15 to 25 quality stocks. These should possess bomb-proof business models, be protected by an impenetrable economic moat, demonstrate spectacular gross margins exceeding 40%, generate overflowing free cash flow, and be virtually debt-free. The ratio of net debt to EBITDA should be under 2. Moreover, they must have explosive growth potential and trade at fair valuations. For 2025, certain sectors appear almost magnetically attractive. Consumer goods giants with cult brands, financial service providers with superior capital efficiency, healthcare companies with patent-protected gold mines, and infrastructure providers with crisis-resistant long-term contracts. Buffett's legendary patience borders on superhuman discipline. Like a predator in ambush, he often observes potential prey for years before striking at the perfect moment. Private investors should follow this example and create a detailed watch list of 30-50 quality companies, assign each a precise purchase price, and then wait like a hunter in a high seat for market corrections. Buffett's wisdom resonates like an echo through the trading floors. The stock market is a device for transferring money from the impatient to the patient. This insight underscores that patience and discipline are not just virtues, but weapons in the battle for returns. A decisive factor in Buffett's phenomenal success is his ability to swim against the current, a veritable counter-revolutionary of the financial markets. While the masses sell in times of panic, he initially remains calm, then strikes with surgical precision once valuations plummet. His gigantic cash reserves are like a loaded weapon, ready to be fired during massive price drops. He recommends holding 20-30% of your portfolio in cash, a war chest that enables you to strike like a financial shark in a bloodbath during a market collapse. Beyond the hard numbers, Buffett emphasizes the crucial psychological dimension of investing. With the serenity of a Zen master, he controls emotions like fear and greed and isn't seduced by short-term market fluctuations or fashionable trends. He thinks radically independently, trusts in deep analysis, and focuses with iron discipline on long-term returns. It's about learning from mistakes without losing courage and adhering to his strategy with unwavering consistency, even when the market is seized by hysteria or gold rush fever. This mixture of sober analysis and emotional control has made him the king of the stock market. Looking toward 2025, Buffett follows a series of revealing indicators. The ratio of market capitalization to GDP, his preferred metric, stands at an alarming 195% and sends a red warning signal. Likewise, he observes with eagle eyes the relationship between aggressive stock buybacks and insider selling. When companies massively repurchase their own shares while executives secretly sell, Buffett senses danger, a toxic combination indicating overvaluation. He also considers widening credit spreads harbingers of an approaching storm in the financial system. Based on these criteria, certain markets appear like shining oases in the desert for 2025. The Japanese market tempts with dramatically low PE ratios under 10 and lush dividends between 3 to 5%. The ongoing reforms in corporate governance act like a turbocharger for shareholder values. Besides direct investments in Japanese trading houses, ETFs offer convenient entry vehicles. In times of galloping inflation, companies with unshakable pricing power shine like beacons in stormy seas. Established consumer goods manufacturers, software giants with high switching barriers, and healthcare companies with patent-protected crown jewels. Buffett's dramatic increase in his energy holdings, especially through massive investments in Berkshire Hathaway Energy and Occidental Petroleum, testifies to his unshakable confidence in this sector. He recognizes not only the potential in traditional, contractually secured assets like pipeline operators, but also in companies that will benefit from the green energy tsunami. Even in economically turbulent times, he bets on selected financial companies as safe harbors in the storm. Banks with conservative loan portfolios, disciplined insurers, and payment service providers with dominating network effects. In summary, Warren Buffett's investment strategy for 2025 remains unshakably true to his proven principles. The value investing approach, concentration on quality companies, and consistent long-term investment horizon form the foundation of his empire. His supposedly secret strategies reveal themselves as a combination of common sense, meticulous analysis, and iron discipline. For every investor, this yields golden rules. Opt for quality over quantity by investing in first-class companies at fair prices. Think in decades, not quarters, and don't be seduced by short-term market fluctuations or hypes. Invest only in businesses you fully comprehend and maintain a hunter's patience. Wait for the perfect moment to strike and remain true to your strategy, whatever the markets may shout at you. As Buffett razor-sharply puts it, the market is a short-term voting machine, but a long-term weighing machine. This insight reminds us that short-term sentiments are as fleeting as morning mist, while true company value asserts itself over time with the force of a natural law. Those who internalize these principles are equipped to build wealth long-term. Over decades, Buffett has proven that stock market success depends less on clever tricks and more on methodical, disciplined work and the ability to stay the course even in raging market storms. Warren Buffett's overwhelming success underscores that complicated models don't make the difference, but profound analyses focus on the essential and the iron willingness to wait for the right moment. While others panic like sheep or blindly follow trends, Buffett builds his empire with the precision of a watchmaker, with simple but unshakable principles as his compass. For every private investor, his approach offers both inspiration and a concrete battle plan for long-term success. Metrics like the PE ratio are not just numbers, but keys to the hidden value of a company. This revolutionary mindset, based on patience, discipline, and unsparing analysis, explains why Buffett will go down in history as the investor of the century. Anyone who internalizes these principles can recognize opportunities even in today's market chaos and triumph long-term. Ultimately, it's about viewing the market not as a casino, but as an arena where wealth is built over decades. And therein lies Buffett's timeless formula for success. The story and strategy of Warren Buffett are a flaming call not to speculate on quick profits, but to commit to sustainable, value-oriented investing, a philosophy that stands like a rock in the surf, even in the most turbulent times. Those who follow these principles will not only survive crises, but flourish long-term and build an unshakable foundation for their financial success.